This is video lecture 1-4, which deals with the basics of the financial statements. This is just a brief refresher. We'll be looking in depth at the preparation of the financial statements later in the course in topics 3 and 4. Of course, financial statement preparation is key for anyone who's going to call themselves a professional accountant, since that is the product that we produce in financial accounting for our users. So let's take a look at our financial statements. We have our income statement, which reports the results of the business's operations for a period of time. Next, we have the statement of changes in owner's equity or in retained earnings. This statement shows the effects of the results of operation, the sale or retirement of any paid-in capital, and what is called comprehensive income. Comprehensive income is something we'll discuss in just a little bit. Our third financial statement is the balance sheet. It gives the financial position of a company as of a certain date. And then we have our statement of cash flows, which categorizes the inflow and outflow of cash into 3 types of business activities. First thing we need to understand is that information flows from the accounting system to the financial statements and within the financial statements in a particular order. The compiling of the financial statements begins with the unadjusted trial balance, where the information is first brought to the balance sheet, the income statement. From the unadjusted trial balance, we'll take out the revenue, we'll take out the expenses, gains and losses, and we will compute net income for the period. Net income from the period flows to the statement of changes, where it will be used in the retained earnings portion of that statement. That statement will take the beginning retained earnings balance, add in net income, subtract out dividends to come up with the new ending retained earnings balance, which will flow to the balance sheet. As the balances of assets, liabilities, and equity will flow from the unadjusted trial balance to the balance sheet, except for retained earnings again, which is coming from the statement of changes. The statement of cash flows will take into account net income and also changes in the balance sheet from one period to another to indirectly determine the change of cash in a period. So let's take a little closer look at each of these financial statements. There are 2 formats for the income statement. In this slide, we are looking at the most common format, which is known as the multi-step income statement. In the multi-step income statement, there are a number of key subtotals that are included in the statement. And these are gross profit, operating income, and net income. Gross profit is our sales revenue minus the cost of goods sold. Operating income is our gross profit minus operating expenses. And what differentiates cost of goods sold from operating expenses? Cost of goods sold are those costs that can be directly traced to the products or services that we provided. Operating expenses are indirectly connected to the products. These are things like salaries for our administrative staff, supplies, including sales supplies, and in salaries that would be including sales commission. Any expenses incurred after the sale would be reported as an operating expense and not part of cost of goods sold. From operating income, we subtract out other income and expenses that are outside of our normal day-to-day business. These would include things like interest revenue, interest expense, other forms of income such as rent revenue or investment revenue. And this would give us a number that's not reflected on this slide, but we'll be talking about, and that is income before taxes. That would fit into here. And from that, we would generate our tax expense. Next is our statement of shareholders' equity. Again, let's concentrate on the retained earnings side, because this gives us a key formula to apply as the information flows. The net income flows from the income statement to this statement of changes. We see here we add in net income for the period to our beginning balance. This company is new, so there is no beginning balance. We add in net income, subtract out dividends, and that gives us the new retained earnings balance. And remember, this is not the balance that we saw on the previous lecture in the adjusted trial balance. So the retained earnings balance that's going to be reported in the financial statements is not going to be the balance that we saw on the trial balance. It's going to be updated by taking net income, adding it to the beginning balance, subtracting out dividends, and this balance will be what's reported on our balance sheet. As GAAP has changed over the years, a new category has been added, which is comprehensive income. This is becoming more and more critical as we move to what is called fair value accounting. And we're going to be discussing this more in depth throughout this course and future financial accounting courses. But for right now, you need to understand that there are some changes coming. And what we now call the income statement is going to be changed to the statement of comprehensive income. So we'll talk about comprehensive income a little bit later. So here is our income, our balance sheet. It begins with our assets, and this format is known as the classified balance sheet. In the classified balance sheet, we break out the totals for current assets. Out of the total assets, current assets are those assets that we will convert to cash or use up within the next operating cycle, which is typically 1 year. We list the accounts here in the order of their liquidity. Obviously, cash is the most liquid, that is readily convertible to cash. And then accounts receivable, short-term extensions of credit, inventory, supplies, etc. We report the current assets as a total, and then we will list out our operating assets. The contra account for accumulated depreciation can either be displayed like it is here, or more than likely it will be presented as property, plant, and equipment net of depreciation, and that will give us our total assets. For our liability and shareholders' equity side of the balance sheet, again, we're going to be presenting this in a classified manner. We will be listing our current liabilities. Those are liabilities we expect to be paid with current assets within one operating cycle, which is typically 1 year. So we would list out all our current liabilities, come up with our subtotal, and this will allow our users to perform the current ratio, which is current assets minus current liabilities, which is a key piece of analysis that we'll use to look at the liquidity of a business. We'll then list out any other liabilities that are not current. If they're not current, these are called long-term liabilities. We will present our shareholders' equity, and again, the key thing for right now is that this retained earnings balance has been updated and is not the balance that is on the unadjusted trial balance. And of course, we must be in balance. Our assets and liabilities must equal each other. The statement of cash flow is necessary because our income statement is based on the accrual method, and net income does not equal cash flow. Cash flow is important to investors and creditors. The statement of cash flows breaks down the inflow and outflow of cash by operating activities, those things we do on a day-to-day basis. Investing activities, that is the purchase or sale of operational and investment assets. And cash flow from financing activities, these involve our capital structure, which is the issuance or repurchase of common stock, the inflows from loans and other types of debt instruments, and the payment of cash dividends. It's important to note here that interest is reported on the statement of cash flows as an operating activity, but on the income statement it is not part of operating expenses. So this little disconnect here causes some confusion. We'll discuss this a bit more and some of the changes that are coming down the road. In class, we're going to be doing a demonstration problem to have you go from the adjusted trial balance to the financial statements.